Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market commentary, macro shocks, tech rotation, and portfolio disclosures. This video presents a direct informational narration of the source document. Let's just jump right in. Today, we're unpacking a highly dynamic period in the global markets. We'll be moving through macro shocks and yield spikes, global pullbacks and sector rotation, key technical levels and the IPO outlook, the recent decline in precious metals, a fascinating look at the presidential stock portfolio, and finally, individual tech stock movers. Let's get going. Starting off with Part 1, Macro Shocks and Yield Spikes. So, this whole wave of turbulence kicked off with a severe downturn across global markets on Friday, May 15th. This happened literally right after the conclusion of the president's trip to China. But what was the specific trigger? Well, it was the 10-year Treasury yield violently breaking through that absolutely crucial 4.5% threshold. When that yield spiked, it acted like a blaring alarm across all global risk assets, instantly shifting the broader market sentiment. And according to the source, escalating geopolitical tensions in the Middle East played a massive role here. We had the Tehran Times reporting that the U.S. completely rejected Iran's four-point plan, and patience with Iran is reportedly depleting. At the exact same time, Israel has been preparing for a multi-day military action, basically waiting on final decisions. These geopolitical conflicts stoked severe inflation fears, completely shattering any remaining market hopes for Federal Reserve rate cuts. Instead, trader bets shifted firmly toward potential rate hikes. To compound all those pressures, the source highlights a really critical timing element. The May 3rd Friday options expiration collided directly with this yield spike. Up until that point, the market had been riding a gamma squeeze on call options. But as the yield breached 4.5% right on expiration day, it was like a starting gun. It instantly transformed all that options enthusiasm into a highly concentrated wave of massive profit-taking. Moving right along to Part 2. Global pullbacks and sector rotation. A really crucial takeaway from the report is just how differently regional markets reacted to this. The document contrasts the relatively firm performance of U.S. indices, which honestly saw pretty limited drops, against the intense volatility over in the South Korean stock market. The Korean market took a seriously heavy hit, with the Kospi 200 suffering a steep 6% drop. That was severe enough to actually trigger a market-wide circuit breaker. Diving deeper into the specific sectors, the source outlines a few major dynamics at play. That massive Korean market drop was heavily tied to sharp declines in Samsung and SK Hynix. And because everything is connected, that dragged down the entire global semiconductor chain. This is huge because the AI supply chain, which includes semis, data centers, and power infrastructure, now makes up over 50% of the S&P. As capital rotated out of those overcrowded AI stocks, sectors like space, industrials, and autos also fell due to inflation pressures. But capital swiftly rotated right into the software sector. That triggered a targeted short squeeze, as risk metrics for those software stocks had hit some pretty extreme levels. That brings us to Part 3, Technical Levels and the IPO Outlook. Looking at the charts, the S&P 500 retreated from that 7,500 level. In doing so, it broke below its 5-day moving average, but it did manage to successfully defend its 10-day moving average. Meanwhile, the QQQ held its daily uptrend line, though the source really emphasizes an extremely dangerous divergence forming right now between the Nasdaq 100 index and the rising 10-year Treasury yield. This volatility was specifically pronounced in semiconductors. The document actually quotes a Bank of America analyst who warned that semiconductor prices had become incredibly stretched. We're talking 62% above their 200-day moving average. A deviation that enormous practically mandates a mean reversion, and we absolutely saw that play out. The SOX index dropped 4%, and the triple leverage SOXL dropped nearly 12%, although it is important to point out that the SOXL still retains a 3x gain from its April lows. Based on these technicals, the source outlines expected market trajectories. Historically, mid to late May is a period of seasonal weakness in adjustment. This volatility is expected to continue right through a highly sensitive transition period, as the new Fed chair, referred to as W, takes over amidst a very inflationary environment. But the market is anticipated to stabilize moving into June, specifically ahead of the massive SS IPO, which is expected to price around June 11th and list on June 12th. Moving on to Part 4, Precious Metals Decline. So this macroeconomic environment basically acted as pure kryptonite to gold. As the source explains, the combination of high treasury yields and a really strong US dollar creates a completely toxic environment for precious metals. It raises the opportunity cost of holding non-yielding assets like gold, and at the same time, makes these commodities significantly more expensive for foreign buyers, which forces prices right down. And silver took a particularly hard hit. Spot silver suffered its absolute largest single-day drop since February 12th. The earlier gains, which had been fueled by intense industrial demand for AI data center infrastructure and some temporary fuel supply issues down in Peru, were completely erased as the macroeconomic tide went out. The drop forced silver all the way back down to test critical technical support at its half-year line. Now for Part 5, the presidential stock portfolio. Recent financial disclosures from NBC and the U.S. Office of Government Ethics revealed some highly active trading behavior. The president executed a staggering 3,642 stock trades in the first quarter alone. That averages out to about 59 trades every single trading day. The disclosures show a sharp pivot, moving away from conservative bond holdings and aggressively into equity plays, with the portfolio's accumulated value ranging anywhere between $221 million and $2.75 billion. Looking at the specific portfolio shifts, the disclosures highlight some massive sales. We're talking in the $5 million to $25 million range of legacy tech giants like Microsoft, Amazon, and Meta. In contrast, capital was aggressively deployed in the $1 million to $5 million range, buying into the S&P 500 ETF, Apple, and heavily into semiconductors like NVIDIA and Broadcom. The source neutrally points out a striking detail here. These portfolio shifts perfectly align with upcoming federal policies. The purchases of semiconductor chips align directly with the White House's push for domestic production. Buying major financials like JP Morgan, Goldman Sachs, and Visa, well, that aligns with the administration's stated 2026 financial deregulation plans. Furthermore, heavy buys in crypto platforms like Coinbase and Robinhood align perfectly with new federal Bitcoin reserve initiatives. This is especially notable considering Robinhood was actually named as a trustee for related retirement accounts. The source also details a specific controversy found within these disclosures. Seven-figure purchases of Dell stock began on February 10th. Later on May 8th, the stock surged 12% immediately following public praise of Dell from the White House. While critics have raised questions regarding the timing of this, it is important to note the administration maintains that all trades were fully compliant with stock trading laws. Finally, Part 6, individual tech stock movers. Figma's stock surged 13% post-market, heavily driven by a short squeeze. Looking closely at their Q1 financials, they delivered an impressive 46% year-over-year revenue growth. However, the source notes a very critical detail. Their gross margins dropped significantly, falling from 91% down to 79%. This compression was due to high AI investments and staffing costs, which resulted in a $142 million net loss, even though they technically beat adjusted EPS estimates at 10 cents. We also saw some major movement over at Microsoft. Shares rallied after Bill Ackman's Pershing Square revealed they had been building a core holding in the company since February. Now, Microsoft stock is currently down 12.5% year-to-date, pressured by market concerns over AI return on investment, Copilot adoption rates, and data center capacity limits. But you know what? The source document totally dismisses these concerns as mere excuses, pointing instead to Microsoft's incredibly strong fundamentals, highly diversified business, and deep enterprise modes. To wrap things up, the source document advises reducing trading activity and simply observing the market over these next 2 weeks. It leaves us with a pretty critical question to consider. As the macroeconomic dust finally settles, how will market flows ultimately react to the upcoming policy directives from the new Fed Chair W? That is a dynamic we'll definitely all be watching closely. Thank you for tuning into this explainer, and I really look forward to reading your thoughts and insights in the comments below.